Howdy, week 151 coming at you from New York City. I'm here for the Inman Conference, hanging out with a whole bunch of realtors. Week 151, if you're new here, that's 151 weeks since March of 2020 when I started doing these weekly market reports because I felt the market needed some context. So many people are waiting for these monthly stats to come out, and by the time the monthly stats come out, you've missed out on so many micro trends that you're just jumping to all these big conclusions at the end of the month versus kind of seeing the less dramatic situation unfold week by week. So that's why I do this every single week. And thank you so much for sharing, subscribing, and doing all of those things. Real Estate Raccoons is here to serve you. See, I'm neither a bull nor bear because I don't believe you can day trade real estate, and I don't believe we should be using day trader or that type of terminology in real estate. I'm a real estate raccoon. We make money and smart decisions in down markets. We make money and smart decisions in up markets and everything in between. Real estate is a long-term game, so hopefully you can see that, and hopefully if you're on this market report journey with me, you are on the same page. And I would love to hear your thoughts on the market, especially after tomorrow's Bank of Canada interest rate announcement, hoping for that baby raise of 0.25% or 25 basis points. That's what we're hoping for. Let's see what we actually get. Okay, so digging into the market this week. For the past 2 weeks in a row, we've added nearly 200 new condo listings to the market. That's the most amount of new listing activity I have seen since like those early panic days of COVID. So what does that mean? Nothing right now because we are still severely undersupplied for both houses and condos in the urban markets all the way through the other communities that we're talking about here. And if you go to the springteam.ca/blog, you can see every single week. You can go back and read all 151 of these if you want and kind of see the supply trends. I will need to map out the supply trend on a new graph. If you've seen the previous graphs on the blog, you know that that's not there, but you can see them in each individual report. So looking at downtown right now, we've got 320 active house listings. That is less, so 52 point whatever, 52.65%, I think the actual number is, fewer listings than we had 3 months ago. So there was pullback, 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 and now we have that typical seasonal, mind you, seasonal. And if we go to my the blog this week, I reused this chart from week 150, but to show a different, last week I was trying to show you just how severely undersupplied we are, like looking at this compared to January of 2023 versus January of 2019. And in the context of all of these other years, we still are severely undersupplied. But what I wanted to show you is the seasonality of new listings coming to market. So looking here, you can see that in January, we usually start off with fewer listings. And as we head into February, with all different property types, we have new listings coming to market. So what we're seeing right now is not necessarily out of the ordinary. So this isn't some sort of panic situation. This isn't some sort of reaction to people losing their jobs, which we'll get into a little bit later in this video. This isn't some sort of indicator of what is actually, what's happening economically. This is just, in my opinion, and from the weekly numbers that I'm seeing, comparing it to previous years, this is a normal add-on of listing supply of both houses and condos, with the exception of like Leaside and Birchcliff. And we talked about those communities last week in week 150. Leaside is that neighborhood, Davisville, Yonge and Eglinton, but more specifically like Leaside and the Davisville area are probably the least risky real estate investment you can make. There seems to always be demand. It has, Leaside and Davisville have the fewest months of inventory, the lowest months of inventory stat. There is never enough supply to meet demand there. But aside from those communities, and even the Kingston Road corridor is severely undersupplied right now. But really, it's the downtown areas that are getting the most listing attention right now. But that's also where there's the most buyer attention right now, too. Looking at the number of houses that sold last week, we're over here. we had 32 house sales here this past week, and we haven't seen this number in the 30s in a few weeks. We've had as little as 5, and we've been fluctuating between like 5 and like 15 sales. So it's really nice to see some buyers come back to market here, and clearly they're scooping up some deals right now because look at, I mean, we're not, this isn't, a really huge number considering this was at $2 million for an average downtown house. All average, I use that in quotes, back in the heat of the Q3 and Q3 of 2021 and Q3 and Q4 of 2021, pardon me, and Q1 of 2022. That's when we kind of hit peak price for all property types across the board. So it's not to say that a $2 million house is now 1.387, but as we've said in many previous videos, the majority of this average price decline is due to the bigger ticket items, those detached and really nice semi-detached North Riverdale type homes that were getting huge numbers into the 3 millions are now notched back to reality a little bit, and there's even less of that activity happening. A lot of those bigger ticket homes like $3 million, $4 million, $5 million, they're just not coming to market the way we saw them come to market earlier in 2022. So don't pay too much attention to average price. Of course, we're looking at the median price, and once the chart is put here, if you're a follower of the blog, you've seen the actual charts where the data points every single week from March of 2020 are there for these numbers. You can kind of see overall how stable it's been, but this is a pretty low number that we haven't seen in a little while. Let's see how that reflects in the marketplace, but we are seeing multiple offers out there in a lot of communities for really nice homes. There's a house in North Riverdale tonight, no parking, well, no legal parking anyway, listed at $2.4 million, has had a ton of showings and should probably sell between 2.6 and 2.7. So there is still that kind of stuff happening, but there's also still a ton of opportunity out there for homes that are just sitting a little bit longer. As you can see, we've got days on market over 20 now for houses, and we haven't seen this in the 20s regularly for a while. So if you're a buyer, things are definitely a lot calmer for you out there. But if you're a buyer, you're probably not really seeing a whole bunch of stuff you absolutely love either. So, buyers do not have a full easy cakewalk out there right now. You're not getting tremendous deals like you think you are, although you are in some cases, but that's not, an across the board situation. What you do have is a little bit more time to make the decision, and you're not competing with like a whole bunch of other people, most likely, on these properties. So anyway, so looking at the supply, and yeah, I got a little clickbaity, I guess, with my title, but hey, I got to get people to read this stuff, you know what I mean? So supply continues to surge, which is most definitely true, and buyers are scared. Buyers are scared of what's going to happen with the future of the economy. And interest rates are a huge part of that. Sure, inflation did pull back, but looking at the inflation numbers, the cost to operate your home has actually increased. So, everyday items are still more expensive. It's just some parts of the energy sector, like gas specifically, has come down enough to offset a lot of the gains in food costs. So, we're not really out of the woods in, we're not sort of in some sort of deflationary territory right now. But looking at the States and looking at Canada, there is some positive news out there which might result in some more activity from buyers. There was a good green day yesterday, January 23rd. In the stock market and crypto world across the board. So that gave some people some positivity. If we have some good news from the Bank of Canada tomorrow at their 10 a.m. announcement on the 25th of January, that's tomorrow. And if they either do their, let me get myself back on camera here. If they either do their expected 25 basis point raise, which will be the smallest raise since the very first one back in March of 2022, the last time rates were only increased by 25 basis points. If that happens again, that will signal a return to normal interest rate activity from the Bank of Canada. Ideally, they decide last minute that they're not going to make that hike, but I don't believe that they will. Like I said in last week's video, for some reason, there's some emphasis being put on the December employment numbers, which I think are massively misleading due to seasonal jobs and things like that. So I really still don't understand why people are paying so much attention to December's employment numbers when that is not at all a reflection of the actual job market right now, which is not as rosy as that report made it seem. Wait till January's report. Wait till the January employment report comes out. I think that's going to be a little bit of negative news as we come out of this month. But if we can get On the back of, stock markets rallying, if we can get a good or expected announcement out of the Bank of Canada tomorrow, I think that's going to rally some buyers. So you might see a little bit more competition in the market after that. And then what's really important is what they announce they're going to continue to do. My idea is not idea, I guess I don't want to say prediction, but what is expected to happen is the Bank of Canada will announce that 25 basis point increase tomorrow. And then they will announce the continuation of their tightening measures, which most likely signals another increase at the following announcement, which is in March. I can't remember the specific day. So that March announcement, in my opinion, is an extremely important one. Because in March, if the decision is made to halt the hike cycle, that's going to bring a ton of buyers back to the market. And make no mistake, like buyers are not on the sidelines right now. The majority of buyers are not on the sidelines right now because they can't afford to get into the market. A lot of people think that that's what's happening right now, where that is the case for some. But there are a ton of people that are just uncertain. They have no idea what the future holds for them, or they might be comfortable with their specific financial situation, but they're so paralyzed by all of the news and information that's out there about the economy that they don't want to make this huge financial decision right now that they believe might be a bad one. But again, that's more day trader type of mentality where most people that make a purchase today aren't in a position where they need to sell it in a year from now, where there's never any guarantee you're going to get a return on that, even though people were misled into believing that that kind of return is possible because we've been in such a, if I want to use the word bull market, or been an aggressive, seller's market for like over a decade in Toronto, with some, of course, some ups and downs like in 2017. But from 2008 onward, there's been quite an aggressive market here in Toronto where short-term gains were possible. Those short-term gains somehow became the norm and the expectation in a lot of places, and people bought and operated in a way that was something that was going to continue to happen, which I think was a huge problem in the pre-construction world. All the demand that some of these incentivized, and I use that word importantly, incentivized agents with big commissions and trips and all that stuff, all of that demand that was created by some of those agents and some of those buyers, a lot of them from overseas, a lot of them local, signaled to developers that there is an insatiable demand for this type of real estate, so they continued to hike their prices to the point where, the pre-construction market essentially makes the condo market. It gives you a window into where the big players, the market makers in the industry, see the condo market going, and the resale market kind of catches up to those like 20 to 40% spreads in price from resale to pre-con sometimes. So pre-construction makes a lot less sense right now for a lot of people, unless you can find some great assignment deals. These are deals to buy from folks that have either they don't want to close on their pre-con units they bought a little while ago. So there still are some tremendous deals in there for opportunistic investors looking to take advantage of people that are fearful. They want to get rid of their pre-con units. I'm not one of those guys. I'm hanging on to everything that I have right now. We've got an awesome townhouse closing at Wonder Condos in April, which I'm excited to get some tenants in. So all of our big investors, all of our smart buyers are hanging on to their real estate right now, and they're even looking at buying more. But there is a lot of paralysis out there right now because of there's a lot of uncertainty in the job market, and, looking at going back to my screen here, and, something that I pulled out of, I'm here in New York just kind of watching Bloomberg yesterday while I was working in the hotel room. And so here's a lot of the big players that are making cuts right now. You've got Amazon dropping 18,000 jobs, Google/Alphabet over here with 12,000, Facebook, Meta, 11,000, Microsoft, 10,000, Spotify, 600 or 6,000 or whatever that is. So yeah, 6,000. So, or no, that's 600. Anyway, I can't do math this early in the morning. But in the context of how many jobs were created since, that's Q4 2019. So basically since the beginning of 2020, end of 2019, 742,000 jobs created by Amazon, 18,000 of those recently cut. I mean, I really like Bloomberg's position on this, talking about the recent cuts just being the regular ebb and flow of hiring, although an aggressive ebb, if that's what you want to call this one. But it does, show me that in the grand scheme of things, these job losses, yes, and those job losses do affect people that might live in the community that you live in right now that might need to sell their home, which might add to the supply, which might affect prices in the short term. That's a very real thing. But in the grand scheme of the economy overall, it really shows me that these companies are holding on to the majority of their employees. And companies like Microsoft, who have committed to $10 billion in investment in their AI technologies like ChatGPT and stuff like that. Like, these types of investments continue to happen. These companies are continuing to evolve and continuing to grow, and they will be hiring again. But honestly, I really don't think that these job losses are an indicator of some deep, dark times still ahead. I think that, number one, we have seen the major price correction already happen. I do feel like homes will either stay at this level, if not slide back another small percentage in some communities. But I really feel like 2023 is the year of the hold. It's kind of the year of stability. It's the year of kind of finding out how we can operate in this higher interest rate environment as we wait for those days where we start getting positive news with rates being pulled back. And looking at some rates being offered by banks, they are kind of seeing that and showing us a window into the future, with bank rates pulling back at the 3, 4, 5 year mark. So a lot of people are locking in some shorter term mortgages over 5%, but you can look at some 5 year, 3, 4, 5 year fixed product that is under 5% right now. And that's directly attached to the bond yields, which have been pulling back over the past little while. So, and that's kind of signaling a brighter future with lower interest rates. And that's what banks are predicting, and that's what they're pricing into some of their rates right now. So I really feel good about the direction we're going in, but I do feel like we have some serious unemployment pain to get through over the next quarter or so, and we'll see what January's job numbers have to say there. But anyway, I think that's all I have for this week 152 coming next week. I will make a short video about the interest rate announcement tomorrow morning at 10 a.m. But again, I encourage your comments, your calls, your texts, all those things, and we can continue this conversation. Real Estate Raccoons out. Have a beautiful day. And if you have any good New York recommendations, I'm here till Thursday, so let me know. Bye.